Hello and welcome everyone to the Closing Bell Show, where you can invest with the best. Today's show, we're joined by Michael Fritzel. He comes on and chats with us about PlayStation and all things Sony and why it's a potentially exciting investment opportunity for the short to medium term. If you're enjoying our content, be sure to check out our full content library at gems.closingbell.co.
I thought maybe it would be a better place to start if you could tell us a bit about yourself.
I'm Swedish, born in Switzerland, but I grew up mostly in Sweden, in northern part of Europe. And that's my background. I studied in Sweden and I moved to the UK to do banking, working in investment banking for a number of years. And then in 2009, I came up with this great idea of moving to Asia, pretty much with no real plan. And I ended up in Shanghai eventually, working for this emerging market fund manager. It was good. And I pretty much stayed on the buy side since then, family office and a hedge fund and another fund management up until now. And then last year I quit my job and I started to write online full time on Substack, which is the crazy idea, but I thought I might as well try it. And if it doesn't work out, I'll go back to fund management. But that's.
Do you ever feel compelled to go back home, or is Asia home for you now? Is Singapore home for you?
Well, it's a little bit difficult because if you're working, in a professional job, there just aren't that many such jobs back home. Of course, in Stockholm there are, but I have a family here, and I need to, you need to find jobs for for the others as well.
Yeah.
So it's a little bit difficult at this point, but I like Singapore. It's a comfortable place to live.
Now, Michael, before we get into the nitty gritty stuff, we always like to start with a few fun and nostalgic questions.
Mm-hmm.
So this one, I'm not sure if you've heard of before, so please do tell me if you haven't. It's a friend, marry, kill question. Do you know what a friend, marry, kill question is? Or have you ever received one before?
No. Marry or kill?
No. Okay.
You have to choose one.
Yeah, correct. There's three people that I'm going to say now, and you have to pick the appropriate word against each name. So Kenichiro Yoshida, the CEO of Sony, Masayoshi Son, the CEO of SoftBank, or Jack Ma, the CEO of Alibaba. Friend, marry, kill. Assign the friendships, the marriage. And the
choice of characters there. I think Yoshida, you have to marry him. He's a Thor, basically. I can think of fewer high quality management teams in Japan, in Sony, and he's up there. Like he's been responsible personally for the turnaround of Sony since 2012. As a CFO and now CEO. I think he's fantastic. Is that Masa Stone? I think I would give him, frankly. I don't think that does his strategy work? It might, but there's talk about his investment in Alibaba being an amazing investment, and it was for sure. But where would SoftBank be without that investment? And what did he base that investment on? He just met Jack Ma and felt that he was a good guy, basically. I mean, it could turn out differently. And we know that after 1999, 2000, SoftBank dropped at 99%. So I wouldn't say it's going to happen again because they have made some really good investments. And they're not as leveraged, of course. But I'm a little bit cautious, Like I just don't know if the analysis is as deep and if the value discipline is as high as necessary. So that's. And then Jack Ma, I think he's a genius, but it's difficult. But maybe I'll say marry there. But I mean, what he did with Alibaba, I think is fantastic. And they were able to beat out all competitors. There were plenty of them back then. Except I don't think it's that easy anymore to beat Jack Ma. Obviously, he's been ousted from the company he founded, or maybe he just resigned. Who knows, right? But he was out of sight for almost 2 years, and I just don't know if it's as easy for him to coexist, with the top leadership. There's talk about personal rift between him and the top leader in China. So it's probably tough to be Jack Ma right now. And I wonder what he's going to do. If he can kind of, continue his success. I'm not so sure.
No, wonderful answers. Comprehensive. And thank you for participating. Next one. What was the first investment you ever made and what interested you about it?
That's actually a good story. When I was working in London, 2000, I guess it was 2008. I was, the bonuses were good at the time. It was before the crisis. And I was working for Macquarie Bank, the investment bank, the Australian investment bank. And I had good bonuses and I wanted to invest them in the right kind of shares. And I set up a brokerage account for the first time ever, 2008. And I funded it and I just sat on that money for throughout this bear market. And I thought I was a genius, like just avoiding the crash, which was pure luck, but that's another story. And then October 2008, Warren Buffett wrote this piece in New York Times about we should buy American stocks. This is the time to invest. And I thought, wow, this is the time for me to go all in. But I was so scared of the crisis and all this headline. So I wanted to go in deep value, like the safest stuff that you could find, nets, that kind of stuff. And I invested in a number of Hong Kong listed, Singapore listed company. That was pure garbage, like awful companies that I mean, they did well most did well in the following 1 year or 2 years, but it was bad. Like looking back, I would have never done them. Some of them went bankrupt, others did okay, but I went for deep value crash, and I wouldn't recommend that.
Sounds like my investment strategy right now. And you know what, Macquarie, it's funny you mentioned Macquarie Bank. I have many friends who are at Macquarie, and they used to refer to Macquarie Bank, Natho, prior to the 2008 crash. They used to refer to as the millionaire maker factory, the millionaire factory. That's what they used to refer to it in Sydney. So, Michael, you were part of that millionaire factory until that big crash in 2008.
Yeah, that's right. I mean, the bonus party I don't know when it was in Sydney, 2017. 2007 maybe. It was something. It was something.
Yeah. And finally, before we dive into the juicy stuff, think of the top 2 people you really admire in the investing world. Who was the second person that came to mind?
Steve Blundell, like Tiger Cub. I've been consistently impressed with Tiger Cub. So people who work with Julian Robertson, it's just so impressive. I don't know, how he did it, how he nurtured so many geniuses. But Steve Blundell, I think, is one of those growth investors who's really nailed it in terms of what timing, trading, finding the right companies to invest in, and just sitting on them. It's just truly impressive. There's not much out there in terms of content, but he will be one of the top ones, in terms of the Tiger Cubs. That I admire, at least.
I thought you could perhaps set the scene in China by talking through some of the key macro themes that are coming out of Asia, and whether you think it's a good time to enter the markets based on all the macro factors at play.
Oh, well, okay. So there are a few big factors. We can start with China. I mean, so the zero COVID policy is, a lot of people are talking about it, and it's obviously the major factor for consumer spending, and that is that's just ongoing. There's no end to it as far as I can see. People talk about the National Congress in November being potentially the trigger of a normalization of policy, or them adopting like a Singapore living with COVID policy. In National Congress, what people predict or what people expect is that once he's secured a third term, he will feel more at ease to kind of let go a little bit. He has nothing to prove. There's nothing, he doesn't have to control the narrative as much, after securing a third term. So potentially we could get an easing of the zero COVID policy after November, perhaps early 2023. And then there's the property market, which is another separate issue. And property investments have started to drop from April onwards. And that's first time in 16 years. We're seeing a big drop in construction and new starts, and that has major ramifications for the economy. It's like 30% of the economy almost, if you measure it appropriately. So that's a big thing, and a lot of listed companies, they're dependent on demand for construction, and also industrial commodities are dependent on Chinese demand. So that's something that's probably not going to recover, even if the zero COVID policy is eased. So you got, on the one hand, you got a recovery from zero COVID. Those will be consumer stocks, travel stocks. On the other hand, fixed asset investments continues to be, and probably will continue to be, weak, because they're now dealing with the over construction problem, quite aggressively by just taking away the credit, taking away the loan, the borrowing from the private sector developers. So we're kind of seeing a little bit of a crash, and I'm not sure if people really realize like how big of an event this is. So I think those are the two big things in China.
Hey, Michael, not too long ago, maybe 12 months ago, just on the property stuff, there was a company that got bailed out by the Chinese government. It was quite a big, they were calling it like the Bear Stearns moment for Chinese property. Do you remember the name of that company? Do you remember the name of that company? And
Evergrande is the biggest one, I guess, in terms of the assets. China Evergrande.
Can you explain what actually happened to cause that thing to happen? Because I read a lot about it, but I didn't quite understand what was the catalyst for that moment.
I mean, technically, what happened was that they introduced rules that forced developers to deleverage, and especially companies with a lot of debt. The companies like Evergrande and Sunak, they were forced to deleverage. Like they were exceeding the limits set by the government, and then they had to sell assets, reduce debt. And at the same time, the government, they stopped mortgage issuance. It was difficult to get a mortgage. And that caused the sales to drop, like the new house purchases. So those two factors have just caused like a negative spiral. Then, of course, there's also talk about state banks stopping their support of private developers. And no one knows whether that's true or not. Like no one knows what really goes on behind there, why they're not lending to these private developers. But if you check the offshore bonds of all private developers, they're all going down. There's no recovery. So it looks like they're going to all default on their offshore bonds, pretty much. I mean, that's my layman kind of interpretation. So it's dramatic. It's almost like an entire sector is going bankrupt. And perhaps, in China, the homeowners will be fine probably because state-owned developers will buy them, will buy all these projects, and you end up with states taking over big parts of the developments. And then the question is, this over construction problem that we had for so many years, is that going to be solved? Yeah, maybe this is the moment.
Now, you very kindly gave us access to your Substack. I had a great time reading it this afternoon, watching some of the videos. Actually, it's a pretty cool feature on Substack to see the video and get the, as you talk through the presentations. I love the presentations too. They were very thorough. And so we have some questions for you on both Sony and Samsonite. We'll start with Sony, and I'll read an extract from your article, and then I have a couple of questions for you. So, the extract is the jewel in Sony's business is undoubtedly the PlayStation segment. It's hard to underestimate how much Sony has dominated console gaming over the last 30 years. For example, 3 of the 4 best-selling consoles of all time, are PlayStation consoles. Can you talk a little bit about how the PlayStation 5 console has performed compared to their previous consoles, and whether COVID had played a big part in their launch of that product? Because I know that there were a lot of supply chain issues. A lot of my friends couldn't get hold of the PS5s. I'm not sure whether that was kind of like that was done on purpose, or whether that was a structural issue at play. So I'm just curious to get your thoughts on PlayStation 5 in the context of the current market.
Yeah, so the console businesses, the gaming console business is very cyclical, and that's always been the case. You will have the launch of the console, and then the peak sales of the hardware happens maybe 2 or 3 years after that, and then software sales will peak maybe 1 year after that. But this cycle was very different because it was released in November 2020. And during COVID, there were stimulus packages basically cash handouts in the United States and many other countries. And people use those to upgrade their home electronics. People were playing a lot of games. That caused a shortage of semiconductors, this excess goods consumption, and that made it very difficult to produce the PlayStation. And there's been a shortage, which I think was basically just due to the market. It's been across the board, and that's persisted to this day. We've now started to see these shortages of semiconductors ease a little bit. You can see that on the Malaysian semiconductor export data from March onwards. It's really taking off again. You're also seeing prices for DRAM memory chips are falling as well. I think it's a broad trend of COVID happened, and the consumer electronics demand was just highly elevated, and now it's returning back to normal. And that's enabling people to again purchase their PlayStation. So you can measure that in different ways. Like there are trackers online which look at inventory at different online retailers, and they're pretty much sold out still. But prices, you can look at those charts as well. Amazon prices have started to come down. So they probably peaked at about $1,000 for the digital version, and came down to about $800 6 months ago, and now they're about $600 versus the MSRP of $400. So demand is starting to be met, but it's not quite meeting demand yet. So I would expect the sales of the hardware to really accelerate, as the consoles become available, and maybe peak, in terms of hardware sometime next year, I would imagine.
Yeah, fantastic. And sorry, do you have an additional point to that?
Yeah, I mean, you mentioned that it's a jewel of the business, and I think that's absolutely the case. There are many parts of Sony's business, but this is really has been one of the key drivers for sure over the past few years. One thing is the console cycle, but the other major trend is the digitalization of games. So it's like 10 years ago, before this all started, people would buy physical games, and then that cost money to produce, by the way. You have to produce the hardware, you have to pay all these middlemen to sell the games for you. Whereas today, you buy them online. You buy them through the PlayStation Network, and they cost nothing to distribute, and it's causing margins to really come up. So that's been, even though the sales are pretty flat for Sony, the margins have come up, and that's largely due, I think, due to the gaming segment. And we're 2020, we were at 50% digitalization rate, and I think that's going to continue. And by the way, that's also causing, in the old days, people used to buy physical games, and then they would sell them to these to offline retailers, and then the games will be passed on. So right now, when you can't do that with digital games, people will buy more games overall. Like it's highly positive, and we're only halfway through that process.
Yeah, that's a good point as well. And then staying within the gaming realms, as you know, Xbox maker Microsoft bought out Activision for $80 billion earlier this year. I think at the time, investors might have feared that Microsoft would remove popular Activision gaming franchises from the PlayStation platform, giving gamers more reason to prefer the Xbox ecosystem. Sony expects that Microsoft will respect Activision's contractual agreements, but do you think this is at all problematic for the Sony ecosystem over the medium to long term?
Yeah, potentially over the medium to long term. That's possible. In the short term, it seems like none of their games is going to be exclusive yet. So there's been an almost irrational rush to secure these major franchises. But in the short term, yeah, so it's a potential risk. And so far this cycle, Sony PlayStation 4 is actually doing better than PlayStation, Xbox X and S. I think they're doing a little bit better. It could be due to supply chain issues for each, but from my understanding as well, the performance is a little bit better for PlayStation, and the marketing and such is also quite good. So I'm not too worried yet. Like I'm not seeing people leaving the PlayStation console over Xbox yet, but it could be an issue for PlayStation 6 or so. Yeah.
I mean, Microsoft would blacklist those Activision games on PlayStation, would they?
It's also, I mean, they also contribute to revenues for Activision, Sony, because it's such a big platform. But, of course, they're trying to get some exclusive games, and both Sony has them, and Microsoft also has some games that are exclusive. That was the reason for Sony's purchase of Bungie, which was, seems almost irrational.
Yeah.
So, it's to me, it's a worry for the future, because the data that I'm seeing is just quite positive so far.
Yeah. Now, change of tack slightly. So I actually didn't know Sony owned so many great franchises and so many great pictures. And you talk a lot about this in your report. But one of the interesting stats that you mentioned was that, global box office revenue dropped 50% from 2019 to 2021 due to the pandemic. That was expected. But I also think that that's a trend that's sort of here to stay, especially with all of the big streamers, your Netflixes and your Disneys. Can you talk about Sony's relationship with the big streamers and how they're contributing to Sony Pictures revenue? I know they've signed a couple of big contracts, and I'm just curious to get your thoughts on that relationship that they have with them.
I mean, the streaming services, they're starting to get really big. So they just signed a $3 billion contract with Netflix and Disney for the use of their IP, including Seinfeld and a few other shows. And it's a lot of money. And, there's potentially excess spending by the streaming companies, potentially as they try to gain market share. And then, of course, there's the movie segment. I think Sony, they're a little bit hedged. I mean, they're selling to whoever wants to, offer access to their customers to these movies. But I do think Sony, they appreciate the fact that these cinemas, they kind of work as they create a splash and they create marketing, because cinemas, they typically only take in the movies that are, at least they have some promise. So normal moviegoers, they go to the movies and then they realize which movies are worth watching and not. Whereas on online streaming services, sometimes you get a little bit lost among all the options. So there might be still a way for, they have some use, these cinemas, for marketing as well. So I think Sony supports some theatrical window before shows are released to online streaming services. And I don't know how, exactly what the movie tenants will be in the future, but it will still exist probably. And Sony is trying to sell to everyone, anyone who wants to buy their content.
Now, kind of moving on, or wrapping up with Sony, it's obviously a legendary company doing well across so many different facets. Do you think at all they have a bit of a shortcoming when it comes to their pace of innovation? Coming up against the likes of other giants like Apple or Google in the software space?
Yeah, definitely. I think, from 2012, so Sony was run by I think a British man called Howard Stringer from 2005 to 2012. And it was really decaying during those years. Since 2012, it was taken over by a Japanese manager called Katsuo Hirai. And since then, they've really refocused each of their businesses to their competitive advantages. So anything that doesn't have a strong competitive advantage, such as the PC business, they just got rid of, sold it. And since then, the performance has really improved a lot. But one thing that hasn't improved is the innovation. And we're just not seeing these truly groundbreaking products that we saw in the 70s, with the Sony Walkman, the Discman, the Sony PlayStation. They were really, done by Akio Morita and his contemporaries. We're not seeing that kind of innovation anymore. The stuff that's in Sony's pipeline, like EV and robots and so on, robotic prosthesis, they're just not that innovative. So I don't think that's really what we should be hoping for. It is not, Sony Jobs, Apple, or Akio Morita's Sony. This is more of they have good assets and they're trying to monetize them in a good way. But I don't think we can expect another Sony Walkman or anything like that.
You would think that you would think that Sony would be very well positioned to develop a gaming VR console, something along those lines.
Fair enough. They do have one. The VR2 is coming, but So yeah, I suppose that could be called innovation as well.
Maybe it's not going to be as big as, well, it may cannibalize PlayStation. And so maybe there's a link up there enabling the PlayStation consoles to be used in a VR kind of setting. I don't know if those would be two separate products or something that's complementary.
I think related, yeah, very much so.
Yeah.
So I guess you can see them. I mean, all these management teams in each of these subsidiaries are really high quality. I think, or most of them at least. So they are doing the right things. It's just not the like truly revolutionary type innovation that Sony used to do.
And wrapping up in 30 seconds, why is Sony a strong investment consideration for the listeners?
Right. Yeah. I don't, I don't do recommendations, but I can tell you about the bull.
Of course. Yeah. Of course.
About the bull pieces. And people talk about the PlayStation 5, the console cycle. Like the cycle is quite early still. It can continue until 2024. Whereas Nintendo is the opposite. It's the end of the cycle, or actually, even. I mean, it's going down. So that's a key one. The next one is the digital is going up. That rate is I don't know what it is, maybe 60 or something like that. 60%. Another thing is the weak yen. Like the yen has really weakened, like 15% or so. And that's just purely positive for EPS in yen terms. And I don't know if people really recognize that fact, that 70% of the revenues are overseas. And then of course, each of these businesses are doing quite well. The image sensor segment is just, is benefiting from iPhone, but they're dominating and they're going to increase the volume soon. The music business is benefiting from Spotify. The picture segment is benefiting from Netflix and Disney. So that's pretty much it. And the multiple is, I think, PE 13 or so. Like if you adjust things properly, actually, 1 year out, roughly, maybe slightly higher.
Fantastic. Awesome. Now moving on to Samsonite, slightly different business. World's largest luggage producer with a market share of 17%, presence all around the world. Can you give us a quick background on Samsonite and their primary business line? And then we've got a couple of follow-up questions for you on their business and some of the challenges they're faced with have been faced with and will continue to be faced with.
Sure. So Samsonite is the world's biggest producer of luggage. It's a pretty fragmented market. They have 13% market share, but Samsonite brand itself is only like 6% maybe, or 7%. And then you have Tumi, which is also owned by Samsonite. And they have a few other smaller brands like American Tourister, which are less relevant for operating profit. So that's pretty much the business. And the key driver there is the number of passengers, air traffic volumes, basically, which have obviously suffered during the pandemic. And I think also Asia is driving growth generally. That's why it's listed in Hong Kong, because they think that China has been the growth driver of the business. Other thing is Samsonite has traditionally been a wholesaler with not that much direct to consumer business. They've been trying to correct that with the online store and opening more self-operated stores. But it's a bit of a challenge having dominated department stores and these traditional retail outlets. It's a little bit hard to convert to a more direct to consumer business. Whereas Tumi grew up as a direct to consumer business and has a very strong brand name. So there's a bit of a risk as more sales moves online that Samsonite might lose some market share. There are a few businesses like Away Travel, for example, which produces luggage and sells them online. It's a potential threat, but I think it's a very stable business. Like it's built on replacement demand. And as soon as people start traveling, they will buy luggage and they will buy whatever brand has served them well. And for most people, I think that's maybe not most, but for a lot of people, that sounds nice.
Absolutely. And besides the COVID related issues for Samsonite and pretty much every other company, it seems like more specifically the US tariffs on Chinese travel goods caused a few problems. Could you talk a little bit about this tariff and how it's affected Samsonite's luggage business in the US, as well as other companies that leverage China's manufacturing hub.
Yeah, Samsonite used to produce, I think something like 80% of their total of all the luggage in China. 2017 numbers, I think, rough numbers. And these tariffs were starting to be introduced in 2018 and then 19. I think they were increased to 25% on Chinese travel goods. And since that was a shock, so Samsonite was forced to increase the prices, I think in the high single digits. I forgot the exact number. Maybe, yeah. And then volumes dropped and their margins dropped as well for obvious reasons. And it's taken them a few years to really move manufacturing to Vietnam and other countries that are not subject to these sanctions. And I forgot the exact number of what the exposure is to China right now, but it's significantly lower. And I think that they will adapt to the tariffs just as well as anybody else. But if you're a consumer, you will buy whatever's available at the best price. And everybody will try to adjust to these tariffs. So it's a matter of how they compete with others. And I think they've done that transition now quite well. In addition, there's now talk of Biden administration loosening tariffs. There are some people that are positive to it, for example. Others are negative to such reduction in tariffs, but it's possible. So that's a potential catalyst, a reduction in US tariffs on Chinese travel goods, in which case Samsonite will benefit.
You talk a lot about Samsonite's debt. I forget the exact number. It was something like $2 billion debt, maybe a bit more than that. We know that the US interest rates continue to rise. Is that at all problematic for Samsonite in servicing their debt levels?
Yes, it is a little bit problematic. Like the full recovery EBITDA, if you measure debt against that, is about 2.1 times. I'm talking net debt now. That's a little bit on the high side. Like if it was a very stable business, I wouldn't worry too much at 2.1 times. But if we have a prolonged pandemic, yeah, it would be slightly problematic. So it is high. And of course, higher interest rates would also pose a problem. I don't know if I really predict that. I think we've seen already quite a big increase in the expectations of interest rates. And I don't expect a major, significant further increase in their borrowing cost. Their debt, they now trades at about 7%. So their 2026 bond traded about 87 cents on the dollar, which is not pricing in distress, but it's pricing in slightly higher interest rates. So their interest expense is going to increase by some margin, but it's not fatal.
And on a more positive note and positive light, similarly to Sony, could you, for the benefit of the listeners, just elevate a pitch why Samsonite is a strong investment consideration, even though it's not investment advice?
The bull case.
Yeah, okay.
The bull case.
The bull case, as others perceive it, like the brand name, it's is strong. Like it is very strong. I think most people know what Samsonite is. People who watched Dumb and Dumber and like they know that Samsonite exists. And for many people, this is the default option. Like for me personally, I don't know what else I would buy. Like I kept buying Samsonite luggage, so I'll probably continue. And I think that's pretty powerful. Even in our online only era, let's say that online sales continues to go up. It's good to have a brand name, and I think they have that. Tumi's brand name, I think, is also quite strong. Together with Remova and perhaps Louis Vuitton, they are quite strong in the premium segment. And there's also growth in the Tumi brand, not only in travel, but also bags, like women's handbags and business related, bags. So I wouldn't say that's necessarily a lot of growth. It's probably single digits. Mid-single digits is probably a good expectation on growth. So the main theme here, like the reason why earnings is going to go up, I think is really COVID. And the data is so clear. Like I haven't seen anything so clear in a long time. Google search queries are back to pre-pandemic levels. So people are searching for luggage different types of luggage. They are interested in it. They are preparing to travel again, and ex-China, by the way. So China is a little bit different, but outside of China, demand is recovering very fast, and Samsonite is going to be a key beneficiary, I'm sure. You can look at different forecasts as well. I didn't mention website traffic, but it's also quite positive. Forecast by trade organizations, they are they expect probably recovery globally by 2024. So that's 2 years out. And as well, they cut costs. They cut about 35% of the employees during COVID. So Samsonite was very proactive in cutting costs during the pandemic. They cut like 260 stores, and they renegotiated leases. I mean, cutting 35% is a lot for a company, and that means that they're basically cash flow breakeven even during the pandemic, like last year, I think. So that's pretty positive. You have basically a cash flow positive business almost, and then the potential for recovery. That's we're now starting to see taking place. So that's one thing. And then you have this tariff thing. If tariffs are decreased, or if Samsonite successfully reduces its dependence on Chinese manufacturing, then that will become a non-issue, basically.
So Michael, just quickly, Nathan, before we switch over, gun to your head, Sony or Samsonite, which one are you going with?
Personally, Sony. Because I think that there is just the online growth that I think people might get excited about. Like the investors, they've liked tech stocks for many years, but for some reason, this one hasn't really caught people's attention much yet. But with this console cycle just being in such a sweet spot, I think this could well be a popular stock. Samsonite itself is a little bit slower growing, and it's a, I wouldn't call it a cigar butt, but it's going to have growth for a certain period of time, and that is over. Like once COVID is over, they will have recovered. And Sony doesn't have a lot of debt either. It's quite safe in that way. So I personally own some, full disclosure, I own some shares in Sony, and I'm going to see this. I want to see the story play out over the next 2 years.